Welcome back to the channel, everyone. In today's video, we're going to settle a debate that confuses a lot of UK investors: ISAs versus SIPPs. Which tax-efficient account should you use? If you've ever scratched your head about whether to shove money into your ISA or throw it into a pension, or how the tax works, this is the video for you. We're going deep: numbers, scenarios, trade-offs, real strategies. And hey, if you like content that cuts through the fluff and gives you actionable insight, hit that subscribe button and ring the bell. Also, if you have a finance tool or brokerage you like, e.g., your sponsored tool, or the BrokerX, drop a note, I'll include a link in the description. Alright, enough intro, let's dive in. A friend of mine, call him Sam, came to me saying, "I've got £10,000 sitting in cash. Should I put it in my ISA or in my pension? What's the difference? Which gives me more money when I retire?" That's exactly what we'll answer in this video. By the end, you should have clarity on what ISAs and SIPPs really are, how tax rules shape returns, when one is better than the other for you, how you can use both optimally. So let's get into the fundamentals first: definitions, mechanics, the building blocks. What is an ISA? We'll start with the simpler one. ISA stands for Individual Savings Account. It's a tax wrapper introduced in UK law that lets you hold assets, cash, shares, funds, etc., without paying income tax or capital gains tax on the returns. Some key features: you can contribute up to a fixed annual limit, for example, £20,000 in recent years, across different types of ISA: Cash ISA, Stocks and Shares ISA, Innovative Finance ISA, Lifetime ISA. Any gains, interest, dividends, capital gains, inside the ISA are shielded from UK taxes. Withdrawals are tax-free. There's flexibility: you can generally take money out whenever, subject to rules of the underlying investments. You don't need to declare ISA gains in your tax return. Because of that, it's popular, it's simple, powerful. One nuance: there's something called a Lifetime ISA, LISA, that is geared toward first-time home purchase or retirement, with some penalties if you take out early. But for our comparison with pensions, we'll mostly focus on the regular Stocks and Shares ISAs plus Cash ISAs. What is a SIPP, Self-Invested Personal Pension? A SIPP, or Self-Invested Personal Pension, is a UK government-registered personal pension scheme that gives you a lot of freedom over investments. It's a tax wrapper like the ISA, but it's geared for retirement and has more restrictions. Some defining characteristics: you make contributions from your earnings and receive tax relief, i.e. the government tops up your contribution via income tax relief. The money inside grows tax-free, no income tax or capital gains inside. However, you can't just withdraw it anytime. There are age restrictions, normally from age 55-57 depending on rules, and limits on how much you can withdraw tax-free. When you access it, portions can be tax-free, but the rest is subject to income tax in that year. If you die before age 75, beneficiaries can often inherit the pension tax-free. After 75, withdrawals are taxed at your marginal tax rate. SIPPs allow more flexibility in investment choice. You can hold equities, funds, sometimes even commercial property, etc., more so than some standard pensions. It's important to see that the government gives you an incentive, tax relief, to save for retirement, but in return you give up some liquidity and accept restrictions. 3. ISA, the tax-free workhorse. So here's the thing about ISAs: they are simple, and that simplicity is a superpower. Think of an ISA as your no-strings-attached financial sandbox. Whatever you earn inside it, whether it's dividends, interest, or capital gains, is yours, free of tax. No HMRC waiting around the corner asking for a slice. Let's break down exactly what that means in practice. Example: the compounding advantage. Let's say you invest £20,000 in a Stocks and Shares ISA and you get an average 7% annual return. You leave it untouched for 20 years. That grows to about £77,400. In a regular taxable account, even if you only lost, say, 15% of your returns to capital gains and dividend taxes over the years, you'd end up with closer to £65,000. That's over £12,000 gone, just in taxes. With an ISA, you keep every penny of growth. And here's where the math gets wild: the longer your timeline, the more the tax-free compounding snowballs. This is why nearly every UK investor, from someone saving £100 a month to someone maxing out £20,000 a year, starts with an ISA. It's simple, flexible, and instantly rewarding. Types of ISAs. Let's quickly go over the main ones, because this is where some confusion starts. Cash ISA, it's basically a savings account, but the interest is tax-free. Ideal for low-risk savings or emergency funds. Stocks and shares ISA, this is the powerhouse for long-term investing. You can hold ETFs, index funds, or individual stocks. Innovative Finance ISA, this one allows peer-to-peer lending, higher risk, sometimes higher reward. Lifetime ISA, LISA, the government adds a 25% bonus on up to £4,000 per year, but you can only use it to buy your first home or for retirement at 60. ISA rules to know. You can only pay into one of each type per year. You can't exceed the total annual allowance, usually £20,000. Withdrawals are tax-free and penalty-free, unless you're in a LISA and you pull out early, in which case there's a 25% penalty. Now, the best part of ISAs? Liquidity. You can pull out your money whenever you want. No age restrictions. No penalties. No complicated forms. That flexibility makes it perfect for medium-term goals, things like saving for a house deposit, funding a business, or even building a financial freedom fund before retirement age. But that same flexibility can be a downside? Because with no restrictions, it's easy to spend the money, and that's where SIPPs come in. For SIPP, the long-term tax engine. Alright, now let's switch gears and talk about SIPPs, the heavyweight in the ring. If ISAs are all about flexibility, SIPPs are about power. They're designed for one thing: maximizing your retirement wealth through tax relief. Here's how it works. Bank the tax relief magic. When you contribute to a SIPP, the government effectively refunds the income tax you already paid on that money. So, if you're a basic rate taxpayer, 20%, and you contribute £8,000, the government tops it up to £10,000 in your SIPP. That's an instant 25% boost, no market risk, no waiting. Just pure tax relief. If you're a high rate taxpayer, 40%, you can claim another 20% back through your self-assessment. That means your £8,000 contribution could effectively only cost you £6,000 out of pocket for a £10,000 investment. That's insane leverage, and it's why SIPPs are so powerful for long-term investors. Lock the catch: access restrictions. Of course, there's a catch. You can't just pull that money out whenever you like. Currently, you can start accessing your pension at age 55, rising to 57 in 2028. And when you do, 25% of it is tax-free, while the remaining 75% is taxed as income. So let's say your SIPP grows to £400,000. You could take £100,000 tax-free, but the rest would be taxed depending on your income bracket at that time. If you plan carefully, you can structure withdrawals so you stay in a lower tax band, but that requires strategy. Chart with upward trend tax-free growth. Just like ISAs, SIPPs also allow your investments to grow without income or capital gains tax inside the wrapper. So that means you're not paying tax on dividends, you're not paying capital gains tax when you sell, and everything compounds faster. But unlike ISAs, you get that extra kick up front, the government tax relief, which can supercharge your compounding from the start. Example: the power of tax relief. Let's say two people each invest £8,000 a year for 25 years. ISA investor, £8,000 goes into a stocks and shares ISA every year. SIPP investor, £8,000 goes to a SIPP, but with tax relief, it's actually £10,000 invested. Assuming a 7% annual return, The ISA investor ends up with £505000. The SIPP investor ends up with £630000. That's a £125,000 difference before considering taxes on withdrawals. Even after paying some income tax later, the SIPP investor usually comes out ahead if they manage withdrawals efficiently, e.g., drawing down gradually to stay in a lower bracket. Briefcase employer contributions. If you're employed, your company might also contribute to your pension, and those contributions are effectively free money. So if your employer offers a pension match or contributes to your SIPP, always take it. It's the equivalent of a 100% return on your money. Warning sign #SIPP limits. You can contribute up to 100% of your earnings per year, capped at the annual allowance, usually £60,000. If your income is above £260,000, your allowance can taper down. There's also a lifetime allowance concept, though it's currently under reform. SIPPs are unbeatable when it comes to tax efficiency for long-term retirement saving. You get immediate tax relief, tax-free growth, employer contributions, sometimes. But the trade-off is clear: your money is locked away until your late 50s, and withdrawals are taxable. That's why the SIPP is for your future self, not your "I might want to buy a Tesla next year" self. 5. Contribution limits, restrictions and eligibility. Let's get into the rules, the part most people glaze over, but understanding this actually determines how much wealth you can build. Think of it like this: taxes and contribution caps are the government's way of saying, you can play the game, but only up to this level. And how you play within those limits makes all the difference. ISA contribution limits. Every UK resident aged 16 or older, for cash ISAs, or 18 plus, for stocks and shares ISAs, can open one. The annual allowance is £20,000, that's across all your ISAs combined. So you could do £10,000 in a stocks and shares ISA, £5,000 in a cash ISA, and £5,000 in a lifetime ISA, LISA. But you can't exceed that total £20,000. Now, here's a key tip. If you don't use your allowance in a tax year, you lose it. There's no carryover. And that's one of those things many people kick themselves for later, because once that tax-free space is gone, it's gone forever. That's why a lot of savvy investors max out their ISAs every year, not because they have a ton of spare cash, but because they understand that tax-free growth is an asset in itself. SIPP contribution limits. SIPPs are a bit more complex because of income-based rules and government reliefs. Here's the headline. You can contribute up to 100% of your earnings, capped at the annual allowance, which, as of now, is £60,000 per year. But there are a few wrinkles. Tax relief limit. The tax relief only applies to the first £60,000 or your annual income, whichever is lower. Tapered allowance. If you earn over £260,000, your allowance can gradually fall to as low as £10,000. Non-earner contributions. Even if you don't earn anything, you can still contribute up to £3,600 per year. That's £2,880 from you plus £720 from the government in tax relief. That last one is huge for non-working spouses. You can literally invest for their future and get tax relief for doing it. Carry forward rule. Here's where things get interesting. Unlike ISAs, SIPPs allow you to carry forward unused allowances from the previous 3 years. So if you didn't max out your pension in prior years, you can play catch-up and still get tax relief. That flexibility makes SIPPs extremely powerful for self-employed people or those with fluctuating income. Strategy tip. If you're building wealth across both, prioritize your employer-matched SIPP contributions first, because that's essentially free money. Then, once you've hit the match, shift focus to maxing out your ISA, since it offers total flexibility and tax-free withdrawals. That combo, pension match first, ISA second, is often the most tax-efficient path for long-term investors. Now that we know how much you can put in, the next big question is, what exactly can you invest in inside these accounts? Let's break that down. 6. Investment options inside ISAs versus SIPPs. This is where things start to get fun and potentially overwhelming. Because both ISAs and SIPPs are like empty boxes, the real power comes from what you put inside them. Let's go over the similarities and differences so you can figure out which box fits your goals best. Inside an ISA. When people say stocks and shares ISA, they're talking about an account that can hold individual shares, like Apple, Tesla, or British American Tobacco. Index funds, like the S&P 500 or FTSE All-Share. ETFs, exchange-traded funds. Bonds or gilts. Mutual funds. Basically, it's the same universe you'd find on any major trading platform. And because the gains and dividends are tax-free, you can trade, reinvest, and grow your wealth without worrying about HMRC taking a slice each year. But here's the pro tip. Don't use your ISA like a trading account. The real magic comes from holding long-term, compounding assets like global index funds or dividend growth stocks, and letting that tax-free snowball roll. Inside a SIPP. SIPPs offer similar, and sometimes even broader, investment choices. Depending on the provider, you can hold stocks and shares, funds, ETFs, bonds, commercial property, REITs, real estate investment trusts, cash, temporarily, but not ideal long-term. Some advanced SIPPs even allow direct property ownership, though that's usually for more experienced investors or business owners using a SIPP to buy commercial premises. The main difference here is intent. With an ISA, you might invest for financial freedom or early retirement. With a SIPP, you're investing specifically for your retirement years, after age 55 plus. That means your risk tolerance and investment time horizon are often longer in a SIPP. Platform options. There are tons of great platforms for both, and depending on your preference, some make more sense than others. Let's mention a few well-known ones, non-sponsored examples, but you can add your affiliate sponsor later. Popular ISA and SIPP platforms in the UK. Vanguard, simple, low cost, great for index fund investors. Hargreaves Lansdown, more expensive, but great support and tools. AJ Bellew Invest, balanced fees and flexibility. Free trade, easy-to-use app, perfect for beginners. Interactive Investor, great for larger portfolios with fixed fees. If you're ready to start investing, I've dropped links in the description for a few of my favorite platforms. Some offer free trades or sign-up bonuses, so check those out if you're comparing options. The investment universe is nearly identical between ISAs and SIPPs, the difference lies in access and purpose. ISA, tax-free, flexible, accessible anytime. SIPP, tax-relieved, long-term, locked until retirement. 7. Liquidity and access, when can you actually touch your money? Okay, let's get honest here, it doesn't matter how great your returns are if your money's trapped when you need it most. That's the biggest philosophical difference between ISAs and SIPPs, liquidity. ISA equals flexibility. Your ISA is like a checking account that actually grows, you can dip in, dip out, and not get punished for it. You can withdraw at any time, for any reason, completely tax-free. That's powerful because life happens. Maybe you find your dream home and need a deposit. Want to take a career break, or need to cover a surprise expense. Having money in an ISA gives you options, and in finance, options equal power. That's why ISAs are ideal not just for retirement saving, but also for medium-term goals, the 5 to 15-year range where you want your money growing, but still accessible. SIPP equals locked until retirement. Now, SIPPs are the complete opposite. Once your money goes in, it's basically locked up until at least age 55, soon moving to 57 in 2028, and this age could go higher over time. That's the deal you make in exchange for those juicy tax reliefs. The government helps you grow it, but you can't touch it early. If you do try to access it early, outside very rare exceptions like severe illness, HMRC hits you with a 55% tax charge. That's not a typo, 55%. So yeah, SIPPs are a future you investment. They're not for your emergency fund, or your dream car, or even that property you plan to buy next year. They're for your freedom decade, when you stop working and want to live off your investments. Example: timing matters. Let's compare two hypothetical investors. Investor A, ISA first approach. Invests £10,000 a year into a stocks and shares ISA for 15 years. Accesses it at 45 to fund early retirement or business ventures. No penalties, no taxes. Investor B, SIPP first approach. Invests £10,000 a year into a SIPP for 15 years. Has a much bigger balance due to tax relief, say £190,000 instead of £160,000. But can't access a penny until 55 plus. Investor A gets flexibility and freedom earlier. Investor B gets more money later. Both are winning, but in different timelines. The hybrid strategy. Here's where smart investors think like chess players, use both accounts strategically. You can split your contributions like this. ISA for short to medium-term flexibility. SIPP for long-term, tax-efficient compounding. That way, your ISA gives you liquidity and your SIPP gives you power. It's like having both offense and defense in your financial playbook. If your money were a car, the ISA is your daily driver. You can take it anywhere, anytime. The SIPP is your retirement supercar, sitting in the garage compounding in value until you hit the age to drive it. You need both if you want the full experience. Now that we understand liquidity, let's make it real with scenarios, because which one's better really depends on you. 8. Use cases and real-life scenarios. Which should you choose? Alright, let's ditch theory for a second. Let's imagine a few real-world investor profiles and see which account fits their goals. Because the truth is, there's no universal winner. It's all about timing, income, and purpose. Woman #graduation cap scenario 1, the young professional, ages 20 to 30. Meet Sarah. She's 26, earning £40,000 a year, and just started thinking seriously about investing. She's got some student debt, she's saving for a house, and she wants flexibility. Here's what makes sense. ISA priority, because she'll likely need access to her money within the next 10 years, for a deposit or life change. SIPP starter, contribute a small amount, maybe enough to grab employer match, and focus on long-term compounding. Strategy for Sarah. Put £500 per month into a stocks and shares ISA. Put £200 per month into her SIPP, especially if employer matches. Rebalance annually. Why? Because flexibility beats tax relief at this stage. Locking money up for 30 years isn't ideal if she's still building her foundation. Man #briefcase scenario 2, the mid-career earner, ages 35 to 45. Now meet James. He's 40, earning £80,000 a year, and already owns a home. He's got disposable income, pays higher rate tax, and wants to maximize tax efficiency. For him, the SIPP becomes a tax optimization powerhouse. Why? Because every £1 he contributes effectively costs him just 60p after tax relief. So if he invests £20,000 in a SIPP, he gets £8,000 in tax relief, whether directly added or reclaimed. At the same time, he can keep building an ISA for flexibility. Maybe to retire early or travel before pension age. Strategy for James. SIPP first, maximize up to tax-efficient threshold, higher rate band. ISA second, £10,000 per year for liquidity and tax-free future withdrawals. By age 55, James will have built a strong SIPP pot for retirement and a flexible ISA pot to bridge the gap between now and 55. Woman #girl scenario 3, the parent investor, ages 30 to 50. Meet Emma. She's a parent, juggling expenses, but wants to invest for her kids' future. ISAs win big here because of junior ISAs, JISAs, which allow up to £9,000 per year per child, tax-free, accessible to them at 18. She can also invest for herself in a SIPP to get tax relief, double leverage if her employer contributes. Strategy for Emma: £200 per month into each child's GISA. £300 per month into her SIPP. £200 per month into her own ISA for flexibility. Scenario 4, the pre-retiree, ages 50 to 60. Now meet David. He's 55, self-employed, and ready to plan his exit strategy. He's sitting on cash savings, paying 40% tax, and thinking about when to start drawing income. Here's the power move. Dump as much as possible into a SIPP before retirement to reclaim tax relief. Keep enough in ISAs to fund the early retirement gap between now and age 57 plus. Why? Because he can live off the ISA for a few years, letting the SIPP grow untouched, then start drawing 25% tax-free later. Briefcase Scenario 5, the high earner, ages 45 to 55. And then we've got Priya, earning £200,000 a year. For her, the SIPP is a goldmine, but she's got to watch the tapered allowance. Here's what she can do. Contribute strategically to stay under taper limits. Use carry forward from previous years. Fill ISA allowance every year for diversification. At her tax rate, the relief is enormous, so even though her access is delayed, the compounding benefit makes it worth it. The best investors don't see ISAs versus SIPPs as a battle. They see them as teammates, each one doing what the other can't. The ISA gives you short-term agility. The SIPP gives you long-term firepower. Together, they're your financial engine.